who is subject to tax? Who is subject to tax? We looked at the assignment of income doctrine, and we looked at Chapter 12 from two different standpoints, right? We looked at performance of services versus property, and we had the famous Lucas case for services, and then by way of contrast, we had Halbring v. Horst with respect to property. Okay. Now, what we're doing, that's a quick update, giving you a context. We spent 2 classes looking at business deductions, right, under Chapter 14. Chapter 14, just to remind people, we have the framework of Chapter 14 is to look at and examine, we have Section 162 for ordinary and necessary business expenses. We have 262 for personal expenses. Section 263, right, for the issue of capitalization. And the beginning of Section 162 talks about that the expenses must be ordinary and necessary, carrying on a trade or business. And we looked at several cases examining what was ordinary and necessary, comparing it to what has to be capitalized. And we looked at what is carrying on a trade or business, because you can't get a deduction unless you're carrying on a trade or business. And then we started looking at the specifics. If you recall, I foreshadowed that we were going to look at Code Sections 162, A, 1, 2, and 3, not I. The textbook, right? The textbook examines what is a reasonable salary, what is travel away from home, and we saw that the word home is an amorphous term, so it's not entirely clear what the term home means. Third and finally, we looked at lease payments. We said that they have to be bona fide lease payments to qualify for a deduction. So we went through those code sections, and then we said there was a peanut butter and jelly section of sorts with 162, right? What is the peanut butter and jelly? Lena, do you remember?
274?
274, right? 274 puts limitations on the deductibility of otherwise legitimate 162 expenses. So we went through, we saw that Section 274, for example, even though a meal may be an ordinary and necessary expense, Section 274N limits that deduction by 50%. 274K, lavish and extravagant. We saw 274M, where if you go, for example, with a spouse, that your spouse, with rare exception, the expenses associated with your spouse are not deductible, right? And then we looked at issues of, say, foreign travel. So that if you go in the United States and your airfare round trip, if you're here in New Jersey, you go to California, to San Francisco on a business trip, you spend 3 days in San Francisco on the business trip, and you spend another week in California. Are your round trip airfare, Jordan, deductible or not? So 3 days to San Francisco, to meet with a client another week. We're just checking out the sites in California. No, we're not vacationing, we're vacationing for a week.
Oh, that's why.
So, suppose I said we had a business trip for 3 days and vacation for 4, deductible or not? Not primarily, so what's your response, deductible or not? Might be the. You got to get this, right? Because you're going to see this on the final exam, and I'm saying that in a way that hopefully people know this. So Wendy, deductible or not? So if you go on a business trip for 3 days and then you spend 4 days checking out the highlights of San Francisco, James?
Well, the airfare would be not deductible.
Why not?
Because of code section 262. Well,
Okay, and what's your
Personal-
rationale?
personal expenses. My rationale is that the time spent on personal exceeded that of work. You spent more time.
So
on
what's
vacation
your,
than
do you
work.
have better authority? Any more exacting authority? Anyone have more exacting authority? Because, look, you can cite it to a client, but your client's probably gonna want better authority.
Is it 162-2B2?
Yeah, 162-2B2, is the trip primarily business or personal, right, Jordan, at the end of the day? Isn't that the test? Right? 162, regulation 162. Right, so that covers that. If we had that same trip, but this time it's to Mexico, same trip to Mexico, 3 days business, 4 days checking out Tulum, which is a famous pyramid site. Or not, in this case, Max. 274H never opens the door to deductibility. You will never cite 274 for the proposition that something is deductible. You may cite for the proposition it's not deductible or that there's a limitation, but you'll never cite it or it's deductible under 274. Kyle?
So it is deductible, but 274C to, how many days did you say?
3
One
days
per person?
business, 4 days pleasure.
3 out of 7 of the airfare is going to be deductible.
Young, you're just,
So, it's not deductible according to 274, except if it's shorter than a week.
you guys don't have this, okay? Let me just make this clear. You don't have it. What do I mean by that? You're nodding, but you can't nod.
What?
You're nodding, I saw you agreeing, but you can't. Selena? I thought I saw you nod.
No, I think I was just looking up. And
Are you agreeing or disagreeing?
with what?
Kyle's answer.
I was disagreeing with the airfare being deductible
Why?
because Louis said for regulation 162-2, it's primarily for pleasure of the trip.
Ah, you never get there. You never get into the limitation under 274, right? The trip is primarily pleasure. Well, will you be mad at me or yourself if you take the exam and get that wrong? Mad at me, but I don't think I deserve that. All right? Because I'm telling you got to know this.
Wait, is deductible?
No way is deductible. Nothing's deductible. It's a primarily, hey, Nellie, if I told you he went to Mexico for 1 day in business and 2 weeks pleasure.
74 wouldn't apply to it because Mexico is technically in North America.
Okay, good.
Wouldn't
That's only,
doesn't matter.
that's only for business
Oh, for
conventions.
business, right. But so if it was for business, it wouldn't that section wouldn't apply to it.
Just reframe your question so I understand what you're
Sure.
asking.
So if you were asking the same question, but the person went primarily for business,
Okay, so now they're going 4 days for business to
well, my
Mexico
bad. The purpose
and 3
is
days for pleasure.
the purpose is for business, but they spend 3 days on business and 4 days personal.
But
274 wouldn't apply to
it
that.
doesn't even apply. He never gets it. Not deductible. Congress did not want to allow people use business as an excuse to take a vacation. Because many of us would find ourselves in Hawaii, for example, for 1 day on business and 11 days horizontal. Not my idea of a vacation. And look, some of you love beaches. In my personality, I got to be doing that.
So with that same instance, like it's primarily personal. So I know the airfare is not going to be deductible.
Right.
But for the 3 days he is there for business, his meals would be deductible up to 50%, right?
Absolutely. And the lodging for those 3 nights would be deductible. All right. So I'm not saying no deduction. The airfare. Okay. That. And then 274, Gian, may apply in other instances where they go away, say, for 2 weeks. Okay, they go away for 2 weeks to China. The airfare is $1,400. Everyone got it? Go away 2 weeks to China. And 8 days business. If I do 6 days pleasure, okay? The airfare is $1,400 round trip. Jiang, what's deductible and what's not? And Jack, see if you agree.
It was too much information. Like,
Right?
It
Goes to China for 2 weeks. Okay? 8 days business, 6 days pleasure. Round trip $1,400. Give me a number. Any of it deductible? If some of it, all of it, and then Jack, see if you agree.
for airfare, not deductible.
Okay, Jack, agree, and Eugene, you get the final word. Well, 274 says a lot. Do you have anything more specific? 274C. And it would be $800. Jack, I try to make the numbers easy. All right?
Oh, yeah.
14 days.
1400, yeah.
All right, all right. It wasn't just a number out of thin air. I figured, okay, let me make it easy. I tried. All right. Everyone got that? And let me just ask you, if we spent in 14 days total, right? Once again, Jack, and 12 days in business, 2 days checking out something significant in China. Yin? Yeah, deductible or not? Say, what conclusion does that lead you to? We only had, and does anyone have a calculator? What's 2 over 14, guys? Okay, 1/7, which is less than 25%, right? All right, I'll take your word on that. And your point, right, Yin, is that, hey, that means that one of the exceptions to 274C applies, right? Because the amount of pleasure does not exceed 25%. Therefore, the limitation under 274C does not apply. We're just back to the normal rules under 162. Ergo, the entire $1,400 airfare would be deductible, right?
Can you just explain? Outside of the U.S.,
Right.
for business, it says no deductions.
Says it allows a proportion, right, based on the amount of business versus personal. And that rule does not apply in 2 cases. If the trip is less than 1 week, or the amount of personal time is less than 25%.
Because in the one where we were there for 2 weeks, 8 days. More than 1 week.
Then the 1 week exception doesn't apply. Since pleasure exceeds 6 over 14 is more than 25%, right, Wendy? And that being the case, the second exception doesn't apply.
Okay.
So neither exception applies. We're in our pro rata rule.
Gotcha. So when I look at this, no deduction applies only when these are the facts.
I don't know if you're reading that right. It doesn't. I don't think you're reading it right. It doesn't say no deduction shall be allowed. Right?
Yeah, because it says no deduction shall be allowed under section 162 or section.
Portion.
Okay.
I told. Did you circle the word portion?
No, I'm not
But I don't know, Justin. If were you here in class?
Yeah.
Did I not say please circle the word portion?
I don't remember.
All right, but that's you got to bring some caffeine with you, Justin. All right. Seriously, I don't mean it badly. I try to look. The better you do, the better I feel. So I'm not trying to. I have no cards up my sleeve. I'm putting everything out there. All right, guys. So I'm trying to emphasize what you should emphasize because you'll see it again, and you'll see it in practice. You'll see it on the CPA exam. These are the kind of questions you're going to see. I expect everyone here, regulation on the CPA exam should be the easiest part, guys. No problems. Okay? I mean, I get, over the years, people say, oh, I don't like being called on and things. No one has ever, I've never gotten, maybe you guys will be the first to complain, they weren't prepared for the regulation portion, okay? So look, when you take your Becker review course or whatever course you take or you do it on your own, no way I can stand up here and teach you everything, but hopefully we'll have the framework. It'll be much easier to absorb, all right? So that's my goal. Again, you're going to have to train yourself, but you know now, hopefully, where it's coming from and how to orient yourself. Right. Questions about travel expenses, get back to me. You're going to see that. You're going to see it again in practice. So let me know. Expenses for education, again, you guys, you've been here long enough. You know, you can look at the code upside down. You're not going to exactly know under 162 what educational expenses are deductible or what are not. But if you look at the regulations under 162-5, you would know. Now, I could, by the way, I reminded myself, if you guys knew I could get it on, anyone have an account with IM, did I say that correctly?
Yeah, IMDb.
Because I just remembered that the name of the show that I was on about business expenses, that this comedy skit was about, Larry Wilmore is the name of the show. But I tried to register for an account to show you guys how business expenses can be taken or not taken. But I could not, anyone feel comfortable logging on up here? And I have no problem if you do, if you could.
IMDb let you like stream
Yeah, it does.
stuff.
Isn't it a streaming
yeah?
service?
Oh, okay. No, I remember like before.
Hey, welcome back. Today is tax day. Now, a lot of you are stressed about cash. Your money is funny and your change is straight. Alright? But don't worry, the nightly show's got your back with our classic annual segment, Thinking Hard with Yard. We play this year after year.
This is
It just
taking
gets
down
better
a boat.
Take a look, everybody.
Now you see why
Every
the show
year,
is
Uncle
canceled.
Sam tries to get all up in your pockets like he's a hooker playing pocketful. That's not cool. So my first tip deals with income reporting. Now my mantra is, the less you make, the less they can take. So I met with the nightly show accountant to work something out. Listen, I just found out I'm making way too much money on the books here. It's gonna cause me some problems. So here's the thing, I need for my paycheck
That's not me.
to reflect a quarter of what I actually make. I got another social security card. How do you split my pay between the two? That would be fraud. Me and you. I see. I know. Don't act like you forgot. We marched. Be here right now. Miami Tide. We got shot. Dogs. You can't split my check into two social security numbers? Can't do it. For everybody. My tip? Why don't you count with some balls?
All right, guys.
Okay. Have you got my money?
And 3 minutes.
It's really taxes up.
Here you
As
go.
far as I'm concerned, you should write everything
162.
off. The trick is knowing how to do it. So I drove to Jersey to talk to an accountant. I was more open-minded. Let's talk tax write-offs, Jay.
Oh,
There he is.
Non-deductible.
Son's leave.
Definitely non-deductible.
I'm independent. I'm dependent on my leave.
Office supply. Since you use the word office, that connotes trade or business, so it should be deductible.
Office airfare,
Yes, deductible.
office taxi,
Use for your office, deductible.
office weed.
my tip, add the word office to everything. That's why I got this office fur coat. For my last tip, I asked Jay to help me pick the better of two investment opportunities, or as he called them, capital versus non-capital assets. Investment question, Jay. I'm weighing two opportunities. One is a Serengeti safari trip, or 1926 custom Harley Davidson.
I don't know too much about motorcycles. Let me just.
Probably the most beautiful bike you've ever seen in your life. Look at that, Jay.
I look pretty bike.
That or dirty ass Serengeti? Which one is it better?
I always dictate everything by the code. This is what we call code section 1221 capital asset. Choice between capital asset versus non-capital asset. Go with the capital asset,
Which is the motorcycle.
the motorcycle.
That's what I'm talking about. Can you give me 1 second, Jay? Babe, come here, babe. Come here, babe.
Hi,
This is Professor J.
Hi, nice to meet you.
That's my baby, Holly. Professor J, can you tell my girlfriend why she can't go to
Okay, with or without?
It's an investment opportunity. The motorcycle is, what do you call it?
Capital asset.
Capital asset. You don't even know what that means.
Yeah, but I do know something. You can kiss my capital ass. How about that? And it can't like home. Let's do it up.
Hey, but, hey. Listen to you, lady, and just go to Africa.
I missed my calling.
City or if you're making
I don't know
that
how to-
visit, press free tickets.
All right, guys, so you see how business expenses are handled here.
Let me do it today. Sure got canceled.
I can see why.
All right, guys, so you know I better stick with my day job with you guys. So we have business expenses. We went through expenses for education. And we saw regulation 162-5, right? And we saw that certain expenses are considered personal under 262. Certain expenses are not considered deductible. And again, regulation 162 says it all. 162-5. Let's take a look at business losses. You guys have been here, done this before. This begins on page 390. Right? Page 390. Business losses, we've said. Losses must be realized, recognized, and allowed, right? Said, Code Section 165 opens the door. But even at Code Section 165, there are limitations. 267, losses between related parties. Code Section 1041, non-recognition. A whole bunch of code sections you always have to meet. Let's look at this problem on page 392. Okay, page 392. Taxpayers and automobile use exclusively in taxpayers' business. Hey, what kind of asset is that, guys?
Oh, 1231.
Don't say, yeah, I mean, but that's not a capital asset, right, Justin? You gotta watch that video again.
You're right.
1231 asset, used exclusively in a trade or business, which was purchased for $40,000 as a result of depreciation deductions, has an adjusted basis of 22. Okay, we know Code Section 1016, right, reduces the adjusted basis by depreciation deductions. The deal was worth $30,000, was totally destroyed in an accident. The taxpayer received $15,000 of insurance proceeds. By the way, I don't know if you saw yesterday the op-ed I had, and did you read some of the comments? I don't know if some of you, did anyone see that? No. Right, well, if you want to get a good, much better laugh, I can't post what was written, okay? But if you put in Star Ledger my name, you'll get a kick out of that. I think you'll get a kick out of the piece. It gets $15,000 of insurance proceeds. So everyone has the visual. Accident. Agreed? Agreed. Was the taxpayer's loss deductible under 165? So what's the amount of the deduction? The taxpayer truly suffered a loss. What was the amount realized? Not a trick question, guys.
15,000.
15,000, right? What's the adjusted basis?
22,000.
Gain or loss? Loss of how much?
7,000.
7,000. Okay, agreed? And what kind of loss would this be? I got to put you on the spot.
Ordinary loss.
And what kind? Any special kind? Part of the hodgepodge. 1231A4C, right? Fire, right, guys? So if there were 1231 gains for the year, this one would still get ordinary loss treatment, except if the gains in the sub-hodgepodge exceeded the losses, right? Just don't want you to forget these nuggets of gold, right? All right, so if your note, $7,000 loss, right? Makes sense? Got that? What results in A above if the automobile had not been totally destroyed but was worth $10,000 after the accident? So economically, how much did the value go down? What was the car worth before the fire?
30.
30, and what is it worth now? 10. Economically, how much damage was caused? 20, right? Everyone agree that there was an economic loss of 20. Agree? If you check out the regulations, the authors instruct you to 165-7B1. Okay, your clients are never going to be this nice. Regulation under 165-7B1. Essentially, the economic loss or the adjusted basis, right? One little I, do the arithmetic of one little I, it's the amount which is the fair market value of the property immediately before reduced by the fair market value of the property immediately after. So that loss is 20, or the adjusted basis of the property. What's the lesser of the two? 20 or 22?
20.
20. Okay, so the allowable loss here would be how much? And they also got $15,000 of insurance proceeds, right? So how much would be the allowable loss? 5, right? Because it's saying your economic loss was 20, but you were made whole by, not made entirely whole, but the insurance company paid you 15, right? So your loss here was how much? 5. Is the economic loss. The value of the property went from 30,000 down to 10. Problem. Okay, everyone got that? Which makes sense. So for your notes, your answer here is -5. Our loss. What is taxpayers' adjusted basis in the automobile, and B above if taxpayer incurs $17,000 fixing the automobile? Right. So what we have here, the original basis, right? $15,000 of insurance. That reduces your investment in the property, plus or minus, they got a $5,000 loss. So at the end of the day, they have a dollars, but they made $17,000 worth of improvements. The basis here is 19,000. I'll repeat. The starting basis is 22. Represents their investment, remaining investment in the property. They were given $15,000 of insurance proceeds. That reduces their basis, right? Because that's money no longer invested in the car. Minus, they also got a $5,000 loss. Altogether, basis becomes equal to 2, but then they made $17,000 of improvements. 3 concludes with just a very short discussion of Code Section 199A. You don't want to spend too much time on because I'm not sure how long Code Section 199A will remain in the code. That's subject to be determined. Talk about depreciation. This is an important concept, and we'll probably spend classes talking about it. To familiar, and we'll keep returning to this. And let me try to get your attention. You will see several depreciation questions on the final exam. So these material that will hold people accountable. Make sure, if you could, I did in an announcement that you should bring with you. I gave a quick example in an announcement, so hopefully you'll have brought that with you. And if you can't, you can pull it up. I'll talk about this in a few minutes. And conventions. In the meantime, let's meander through Code Section 168. And again, I think the best way to do that is to look at the code and let me make some points, okay? So Code Section 168, everyone has open. Now it says Code Section 168A, except as otherwise provided in this section, depreciation deductions provided by Code Section 167 for any tangible property shall be determined, and it sets forth three things we need to know: the applicable depreciation method, the applicable recovery period, the applicable convention. So for exam purposes and for purposes of your client, the three key elements: ascertain the correct dollar amount of depreciation deductions. So you're going to have to know all three. Also bear in mind, just like Code Section 132, if you recall fringe benefits, 132A starts off with a whole list of exempt fringe benefits, and then the code elaborates what is the meaning of each. Well, similarly, the code will now elaborate what is the meaning of each. What is the applicable depreciation method? Well, except as it provides except as otherwise provided. It's the 200% double declining method. Okay, most of you are used to doing this for GAAP accounting, right? And then when you have to switch when straight line becomes larger and the 200% double declining. In certain cases, property 15 and 20-year property use the 150% method. Look at 168B3. With respect to residential and residential property, meaning commercial property or residential property, you always use straight line. And salvage value is treated as zero. So we're not going to have a salvage value here. Can elect, I've never seen anyone do this, to have a slower depreciation method. Can elect have a slower depreciation method. Don't see that too often. Everyone got it? If I ask you what is the most popular method, it's the 200% double declining. When it comes to real estate, it's the straight line method. The applicable recovery period, right? How long are you going to depreciate the property? 168C, you need to know if it's 3, 5, 7-year property. How are you going to do that? By looking at 168E. 168E says, except as otherwise provided. If you look to the right, it says, if such property has a class life of, it gives you different class lives, and based on the class life, the property is treated as 3, 5, 7, 10, 15, or 20-year property. Just bear in mind, guys, for exam purposes, I would tell you the class life. You will not have to do any research during the exam to ascertain what is the class life. Let you know that, okay? So that is not an exercise you have to do. And may have other concerns, but I will supply you with the class life and off to the races you go. That's not something you're going to have to. By looking at 168E, you can figure out 168C, right? The third leg, what you need to know is the so-called applicable convention. What is the applicable convention? Let me say, many students miss, okay? Many students miss. Hopefully hopefully no one here, because they get the first two, but they fail to do the depreciate the applicable convention. Okay? Now, conventions come in several flavors. Right? Say that. Conventions come in 4 flavors. 4 flavors, guys. The most popular convention is the half-year convention. So why does Congress choose the half-year convention? Assume that most taxpayers put property in at the beginning of the year, or the middle of the year, or at the end of the year. But on average, taxpayers put property in service July 1st, right? And that means if they put it in, get a half year's worth of depreciation the first year they put in service. And in the last year, you get a half year's worth of depreciation going out. Make sense? Sure. And if you sell property anytime, whatever convention you use going in is the same convention going out. Half-year convention is the most popularly used convention. But always concerned that taxpayers may seek to get significant deductions in a particular year. So what might taxpayers choose to do? Gee, we'll put all of our property in service December 31st, right? And then we'll get a half year's worth of depreciation, but we only own the property for a day. Congress, in its wisdom, said, in that case, if you put more than 40% of the property in service the last quarter, you're forced to be on what's called the mid-quarter convention, okay? Mid-quarter convention. With respect to real estate usually costs big bucks. So Congress wants to be more exacting with real estate, right? You can tell this is like throwing hand grenades with a half-year convention. It's not very exacting, right? And mid-quarter tries to be somewhat more exacting. But then with real estate, because the stakes are much higher, there's so much more dollars at stake typically. It requires something called the mid-month convention, right? That's going to be much more accurate than the other two. Agreed? By way of example, how much depreciation would you get if you put property into service, say, commercial property into service, say, in February? How much depreciation would you get? Even going to tell you, let's say the property costs $390,000. Don't be surprised, I didn't just pick that number out of thin air. 90,000. What's the useful life? Commercial building deemed to be 9 years. We put it in service in February. 10.5 over 12 times 1 over 39 times 390,000. Right? 0.5. Not tricky, guys. 0.5 would be, right? Right? Property in service in February. Suppose you sell it the next February. How much depreciation would you get? What would be in the numerator and denominator? You sell the real estate. February 1st, 2019, you bought it. February 28th, 2020, you sell it. How much depreciation would you get in 2020? What would be the numerator and denominator? I want to say? Not a trick question. 0.5 over 12, right? Remember, in February when you buy it in 2019, notice it's 10.5, but when you're selling it in February, you got to flip your thinking, right? Because now it's at the beginning of the year. You should have only 1.5 over 12. Students make a mistake on the exam because they don't do that. February, they think 10.5 because we can do the arithmetic. January it's 11.5, February 10.5. You do it so you get to 0.5. But then the flip is true if you sell it, right? Just the fourth method, we talked about three methods, right, so far. When it comes to intangibles, the purchase of intangibles, it's called the full month convention. That if you purchase some sort of intangible, goodwill, purchase goodwill, it becomes, in February, becomes 11/12 over times, you'll see in Code Section 197, intangibles are typically depreciated over 15 years. 15 years. So if you purchase intangibles in December, you get 1/12. The full month convention. So you have four methodologies. We're going to go through several examples, obviously, towards the end of the chapter. But I just wanted to, give you notice. Most common mistake students make, or one common mistake. And I've seen practitioners forget to apply the convention. You cannot forget to apply the convention. All right? So I should ask people if they're willing to take the oath of not applying that they will apply the applicable convention. So those are the big ones that you got to keep in mind. We will look at other ones just to call it to your attention. The book, and page 394 talks about why even have depreciation deductions. And we know, you guys know from your accounting courses, why do we have depreciation deductions? Matching, right? Everyone agree? You want to match, have more accurate measurements of measuring your income. So if you buy a sewing machine, and it costs you $10,000 for a fancy sewing machine, and its useful life is, say, 10 years. If you deducted that entire cost the first year, it would look like you have a big loss, but hey, it's producing income for the next 9 years. The notion of depreciation is, hey, we should take depreciation over the object's useful life. To juice up the economy, we'll periodically say, gee, let's have an accelerated cost recovery deduction system. Accelerated cost. And sometimes it becomes so, how do I say, it impacts companies' decisions, right, to purchase items because they can front load the deduction to get a very accelerated upfront. They can deduct the entire purchase price. And truth be told, we're going to see this towards the end of this chapter. In the 2017 Act, Congress did juice up the economy. Beginning in 2018, for most items, you can expense it. And that's supposed to end very soon. But if you wonder, and again, this is not a political statement, that why was the economy forecast to not do well in 2018 and 2019? Well, Congress did juice it up. The question is, it's cost the Treasury a big bucks to allow this immediate deduction. Is this sustainable, right? But anyway, let's just get back to general rules of depreciation. Page 395 emphasizes this must be a 1231 asset or some asset, held for the production of income. We're going to see it must be a trade or business income or something held for investment purposes. Generally, it requires that the property have some sort of useful life. For example, you can't depreciate land, right? Because land does not have a useful life. Create your own goodwill, not purchase goodwill. When you're a restaurant and you do a great job, and now the company becomes more valuable, and the restaurant itself, the assets of the restaurant, right, create a goodwill. You can't depreciate that goodwill. Page 397 talks about the depreciable amount. 397, it continues about the depreciation methods, which we just spoke about. Every time you take depreciation deductions, what happens to your basis in the property, guys? It goes down, right? 16, right? I'm just stating the obvious, that your adjusted basis in no way, form, or manner reflects the property's fair market value, right? Adjusted basis is just a number. Back in 1980, introduced accelerated cost recovery deductions, but it was so generous and cost the coffers of the Treasury so much. Then President Ronald Reagan had to reduce the amount of depreciation deductions. Thereby, we earned the acronym MAKERS, right? MAKERS is modified accelerated cost recovery system. Why modified? Because the first was extraordinarily generous and was accelerated. This was now keep in mind, this is not something you can pick and choose. Congress does not like when taxpayers have options to pick and choose whether to deduct. So when you put something into service, it must be depreciated, okay? If you choose not to take the depreciation deductions, that's your business, but most taxpayers I know want to take the depreciation deductions. If you don't, your tax basis still goes down. Your tax basis still goes down. On page 401, there's a short conversation about recovery periods. Last line on page 401 on that section of recovery periods talks about depreciable real estate, useful life of 27.5 or 39 years. Salvage value is deemed to be 0. 2 talks about depreciation methods, which we just did, and 200% double declining, 150% in straight line. Conventions. On page 403, there's a discussion of so-called anti-churning rules. I wouldn't worry about that. That's sales between related parties, okay? Those are sales between related parties. It's very similar. I'll just make that observation. Completion is very similar to depreciation. What about this Sharp case? It's a kind of fun case. What about Sharp and Simon, and then we will talk about your exams. Okay. So the Sharp case dealt with an airplane. Does anyone talk about it? You heard me talk too long? Want to talk about the airplane? The U.S., any volunteers? Someone wants the honors? Great. You guys want to hear me? So, your person, taxpayer, an asset which they use in their trader business. Justin, you would say 1231 asset, right? They use 75% of the time for personal use and 25% for business, okay? So everyone has the visual. They subsequently sell the plane, okay? They subsequently sell the plane. Let's put it this way. Let me rephrase that. They own the plane. They take depreciation deductions, okay? They take depreciation deductions on the plane. How much were the depreciation deductions? 168. They ended up being $13,777.92. As Nelly just pointed out, you got to reduce your basis. Right? They claim it's this. Plane. When you hear the word sale, what code section comes to mind? I don't know, like the way you think. They sell for $35,380. Okay, I mean, I realize experience, anytime a taxpayer doesn't take a loss, it's the case, at least in my experience, is that sneaks something under the radar screen. Okay, so the taxpayer said they're not going to take the loss. Anyone recall what the court says should be done here? Does this seem right, or is there a problem here?
Most of it was used for, most of the plane's use was.
So, at the bottom of page 405, the IRS says, gee, really is two planes, not one plane. Okay? Two planes, not one plane. The business portion of the plane and the pleasure portion of the plane. And we're going to take the original, the 54,000, and we're going to bifurcate it, right? And the personal portion of the plane? No, right? Just like when you guys buy a car or a house that you use for your own personal reasons, right? It's not an object used in a trade or business, no depreciation deductions, right? So that depreciation of 13,000 can only be allocable to the, or adjusted basis, right, is 520 as to the business portion, right? Plane is sold. This is the pleasure part remains 39,974. Now the plane is sold, right? We're told that it was sold for about 35,000. We're going to take that, and we're going to divvy up that 75 essentially. 25% to the business portion. There's two different planes. Now, in the loss, this loss be taken? What do you think? Can this loss be taken?
Code section 262.
Say again?
262.
The better one is 165. Allows losses that don't, right? Does not permit losses that are not trade or business or investments. On the line, David, James, what's the character of that 8,800? David?
I'm leaning towards agreeing because you said that loss can't be taken, so I don't know. I'm gonna.
At the 8,800 though.
Yeah, I agree. That's a gain.
What's the character?
I think it's 1231 capital gain.
You're putting your job on the line. Kyle, you too?
I think it's a capital gain.
Anthony? Max? You did?
So it's not sold 31.
Anyone disagree? Getting the jelly?
Oh no.
Oh, Joe.
Oh yeah, you're right. Ordinary because it's not 1231 it's not a 1231 asset.
Oh, Kyle, I'm missing it. Say again?
It's not a 1231 asset. It is?
The jelly. What's the jelly?
I don't use jelly.
No one's got we got the peanut butter, we don't have the jelly? What do you have next to 1231 written in your code? You have it right because there's only one asset, it's sold. Remember next to 1231? Think of what other
1245, 1249.
1245, 1250. Is this not ordinary income, recapture income? Think how bad your day would be if you had told the client that this is capital gain, and subsequently the IRS nailed them for a penalty, interest, and whatnot. Is the client going to say, no problem? You're going to go for your jugular. That's the day you contact your malpractice carrier?
Are tax preparers responsible for the difference?
Absolutely. It's your professional responsibility. Client client's not gonna say, the client, you just bill the client $3,000 to do the return. And some of my students will periodically ask, well, doesn't that cap my liability, whatever fee I charge? No. The client gets hit with a $100,000 penalty, they're going after you for $100,000.
But if it's a given, why would they even care? Tax
You're gonna give it.
preparer has to pay the fee, right?
No, I said the penalty.
Yeah, the penalty. So if I'm a taxpayer and I have BMO do my taxes and
Right.
the IRS sends me a $100,000 bill, what do I care if I'm just going to give the bill to BMO?
Well, you don't care as the taxpayer, but Vino better care and better get it right.
Yeah, but yeah. I just
But
thought you said
you're
that.
all
I just
your
thought-
females in this room.
I thought you said that the taxpayer would kill the tax preparer.
Well, you're getting hit with the penalty.
Yeah, they're not happy
Not
too
paying it.
because they got to go through.
You have to sue him for the money.
Don't. You just
No,
said
I would
they're
have to pay it.
responsible.
No,
right?
because you're the taxpayer. You file the return for him. Okay?
He's the tax
he
return
gets-
preparer.
He gets the return back. He
Yeah.
gets the penalty.
And
he
then he just-
contacts you, sues you to get the money for the penalty.
Oh, it's
because it
not
was your
just
fault.
automatic. I have to sue BMO.
Yeah.
Oh yeah.
Yeah.
But
Like,
it's
why
not
can't I
going to
just
say, where do I
offer
write you a
$100,000?
check?
Well, you just that's you settling.
You have to pay the taxes.
Like if he filed his return
Yeah,
late,
it's
he gets
penalty.
feed for that. He's going to charge you the fee.
Oh.
He can sue you if you don't pay the fee.
Anything that's wrong, guys, anything and everything that's wrong, the client will never take ownership, okay? Even if they misfed you the facts, somehow they're going to say, oh, I told you A, B, and C. To blame person. That's why you really need to document your records and get it right. Just know that, right? So I just want to point out that this is a dangerous world that we live in. All those ads that people see, they're indoctrinated. Where if you get into a car accident, it's never your fault. It's always someone else's, and we can sue to recover. So that gets ingrained and it extends to the sphere of accounting and tax return preparation, like that. So if you blew this and said, oh, capital gain, okay, and it's ordinary income, and there's add a few more zeros here, and there's a hefty penalty, it will not be a pretty outcome. Okay? Now, just pointing out all tax practice, accounting practice, there are stakes here. Just for your entertainment, on page 406, I just called your attention when we were talking about long-term and short-term capital gains, if you recall, in chapter 22. If you look at the bottom, you see that case, Paul v. Commissioner, talks about holding periods, right? Remember, we had someone who finished one floor out of a two-floor building, and the court split the baby in half. I'm just calling that your attention. So who wins in this case? Does the taxpayer win, or does the commissioner win? In this case, the commissioner won. The court said there's plenty of, even though there weren't two planes, the court said that's a perfectly fine way to look at this. That even though there was only one plane, and the taxpayer said, you can't arbitrarily bifurcate this into two planes, the court felt very comfortable that this was the IRS analysis was the correct approach. Okay. So why don't we do this, guys? We'll break all norms here. Let's take a 2-minute break, so literally 2 minutes, and then if you could just come back and line up alphabetically by last names, that'd be great. So the question is, what happens here? And if you take $60,000 worth of depreciation deductions, what happens to your adjusted basis, guys? Down, right? 40. And consider if they sell the property for $10,000, the gain or loss here.
This goes down to 40,000, and then your loss is 30,000.
Right, $30,000 loss. What kind of asset is this? It's an asset used in a trade or business, right? So it should be an ordinary loss, right? Sell it for what? 60. The basis is what? 40 still. So the gain here is 20, unrecaptured gain. 1250 unrecaptured gain. If you sell it for 110, the gain is going to be 70 overall, and part of it is unrecaptured gain, and part of it is 1231 gain, right?
For 1B, what's the character? Is it capital, ordinary?
Well, it should be unrecaptured 1250 gain.
Oh, so that's the right answer. It's not like capital.
Professor, do you mind breaking it out for
So the first 60 is going to be 1250 unrecaptured. The other 10 is 1231 gain. It's pretty lenient. Some of you took some liberties about how you might have read the problem, so I was somewhat lenient. And sometimes if you see me just circle things in red, I'll call those suspect answers. But I try to give you the benefit of the doubt. So I did not subtract if you see something in red if I didn't put an X through it, if I just circled it, meaning I didn't really like what you did, but I'll give you the benefit of the doubt this time. Didn't we do problems just like this in class? I mean, literally. Let me just also, I'm going to say this probably 2 or 3 more times. My experience, some of you may be listening or will listen to this on a recording because you're not here today. The more you come to class, the better you will do. All right? It's just correlation between the two. All right? So choice is yours. I'm here. You'll keep me posted. Taxpayer purchases land in Newark for $10,000. She discovers the property is worth $10 because it contains mercury. And she contained a loss. If she sells the property, how much would the loss be? What would be its character? Well, all I was looking for here is, yeah, she could get a loss of $9,990. What's the character? She held it as an investment. So that's a capital loss, right? It's a capital asset, right? Now she sells it for a gain because now it's worth $1 million, right? What would be its character? Well, guys, this is, people would say undergraduate tax. That's an undergraduate tax. Both of these, all these questions. $990,000 capital gain, right? Diamond wedding ring. Must you report the income? Well, you guys know the answer. You know from our first class, she has to report the income, right? $10,000. What's the character? Well, there's no sale or exchange, so it's got to be ordinary income, right? It may be a capital asset, but the discovering of the ring itself, there's no sale or exchange, so Code Section 1222 precludes capital gain treatment, right? It's got to be ordinary income. So she subsequently wears the ring, meaning it's a personal item, and she sells it. Well, $1,000. Now she's selling it, so it's a capital asset right on her hand. Capital gain. Now she sells it for loss. James would say, right? James 165 precludes that loss, right? Loss, and it has no character.
So what's the actual loss amount?
Well, there's a $2,000 loss, but it's not allowed. And no character. That was the answer I'm looking for.
Not allowed.
0. That's what I was looking for. When we spoke about personal losses are disallowed. And same thing with her residence. Purchase is her personal residence, same thing, right? You can't take a loss on your personal residence. Or forklift. Okay, we're not dealing with a tractor, we're dealing with a forklift, 1231, right? Purchase price is $10,000. She takes $9,000 in depreciation deduction, right? So what's her adjusted basis, guys? Now, no one in this room should have gotten this problem wrong, right? No one. How many times did we do this? David, you're laughing. You're wrong or right?
I got 2 out of 3. I'll take it.
There's a $10,000 gain, right? 11,000 minus, right? 1 is 10. The characters, 9,000 recapture, 1,000, 1231 gain. Question B. 3 years later, she sells the forklift for $500. Well, Her basis was 1,000. She sells her for 500. It's a $500 loss, right? Ordinary, right? Because it's the only asset. And Jordan, you would say it's ordinary, right? Because it's 1231. It's B, except that in year 4, another forklift, originally purchased for $10,000, has $9,000 depreciation and sold. How much did she report? So we know numerically, right? Let's report 11,000. That's easy enough. Code section 1001. What I was looking for is, could anyone apply? And many of you got this wrong. I don't know why. All I was looking for is 1231C, right? That you had $500 that you had to recharacterize, right? That's based on problem B, right? You remember 1231C? You had $500 worth of ordinary loss, so that forces you to recharacterize. You would have, everything would be ordinary except for 1.5 thousand or 1,500 of capital gain. You got that, but most did not. Question 4.
That's a quick question. So what answer were you looking for on the left-hand column there?
11. This is, again, nothing tricky. This is math 101, addition and subtraction. Section 1001. I truly want to feel good, and I feel good if you do well. I was not asking any trick questions. What are you going to say?
Yeah. So you said that there was a 500 recapture.
Yeah.
So if you put 10,500, that would be wrong, even if you wrote that it was a recapture.
I don't know what you mean by 10,000.
Because you said the answer was 11,000, but if you applied the recapture.
But that doesn't reduce the numerical outcome, right, Anthony? That is wrong. 11, right? 31C does not change the numerical outcome, right? 11 is definitely the right answer. On the right-hand side, it's a matter of what you're raising is what's the character.
For 3C.
For what one, Hassan?
3C.
We said the gain was 1,100, right? 11,000, right? 1.5 at 11,000 is capital gain. And the balance is recapturing ordinary income, 2,500. Question 4. 2019, Jay gives a painting that he purchased for 100,000 at a time when it was worth 450, right? So the painting had appreciated, right? And subsequently sells the painting for 80,000. What is the recipient's basis here, guys? Again? 100, right? What's your authority? What's your authority? Well, your list of code sections that you should know by this time of the semester. And 15, right? The basis here is 100,000, right? 1,000 for what? 80? Gain or loss, guys? Loss is 20. Oh. Capital asset. Anthony.
So you're saying when you put an X, you're taking away points?
Yeah.
You just said that there was a basis transfer, and I wrote the words basis transfer, and you put an X through that. I wrote basis transfer 1015A.
After the class, I'm not infallible.
No, I'm just scared to show you the rest of it. I don't know what else.
Just show me after, okay? If there's, I have a lot of exams to grade. 200 people, so.
Yeah, no, it's okay.
No. I'm not. If I got it wrong, I got it wrong. I was expecting a number, Anthony, just so you know.
Okay.
But I'm willing to give you the benefit of the doubt. All right? Any gain or loss was his character. Suppose the recipient sells the painting for 120. Guys, no one, I have to say, no one should get these wrong. All right? No one. I mean, if you were paying attention and you studied, easy, 20,000 long-term capital gain. It's Not asking any tricks, nothing up my sleeve. Question B, the basis of 100 sold for 120, gain of 20. If the painting was worth 80,000, it was subsequently sold by its recipient for 85,000. So you guys have seen this before, right? No offense to me, I wasn't being very original, right? All right? What'd you get? Loss, right? Straight from the regs, 1015-182. We went through this problem. The facts. In problem A, painting purchased for 100,000. Now the taxpayer dies when the painting was worth 80. Suppose the taxpayer subsequent, the recipient sells it for 75. What code section applies here, guys? Right, Nellie? Gain or loss? Loss of 5,000. What's the character? Capital asset. And these were give me points. Okay? Give me points on question 5. Corporation sells the stock for 120. Red Corporation owns stock for 100,000. Holds it for 3 years. Sells the stock for 120. Again, everyone should get this right. 20,000 capital gain. Corporation sells it for 80. Well, now it's capital loss, but capital losses aren't allowed to corporations, right? Section 1211. That's it.
What's the quick answer for 5B again? I didn't hear you, sorry.
My preferred answer was 0. Right? Corporations are not allowed capital losses in excess of capital gains, but this was the only capital loss they had. Expect the same sort of questions akin to this on your final exam. In my mind, unless you tell me otherwise, really straightforward, guys. Straight from things we did in class. No curves. So if anyone wants, you can, on a particular Monday, we can talk about coming up to my office to talk about your multiple choice. But right now, just absorb your short answer. If there's something, if Anthony or someone else think I misgraded something, that's fine. I'm more than willing to take a look. So I'll take a look after class, guys, if that works for everyone. Anyone has any other questions? But just by a sign here, not in class, 1/3 of the people, 1/3 of your classmates aren't here. So I say again, you're not going to do well, or you may not. And look, if you do well, great. But if you don't come to class or you're not on the WebEx, that's not going to bode well. Generally. But again, there's exceptions to those rules. So any other questions before we go on and pick up where we left off, guys? Just final words, not final word. But if the exam was not the way you wanted it to be, there's lots of opportunity to improve the final outcome. I strongly recommend if you didn't practice using the question and answer book that's available in the Black Letter Law series, those 2 different books that have sample questions and answers, you can really test yourself and hopefully really do well. There's lots of opportunities out there to get books that have sample multiple choice questions, true or false, sample short essay kind of questions. Page 409. Any musicians out there? Any musicians? Bimo, you're smiling. You're playing the instruments.
Couple.
Give us some examples.
I play the piano and the drums pretty well.
Professionally or not?
Professionally, but like I'm pretty
yeah.
good. At that.
Any YouTube that we could play for?
Nah, I don't. No.
I figure if we're gonna put our cards out there, you might join me up there. All right.
I
Well,
can upload one.
you want to upload one and we'll
Maybe for some
watch
extra
it
credits.
together. Maybe again, let me give a little pitch. There's always time. A week from Saturday, if you haven't signed up, email. Maybe you want to do the piano. Be sure to welcome guests. We'll get a piano here. So again, if you guys haven't signed up, consider doing it. So, meanwhile, now I'm going to put you on the spot. Do you have a chance to read this case?
No, I didn't.
It deals with your heart and soul with musical instruments. Kyle, do you have a chance?
No, I didn't read this one.
Have a chance? In. Chance to read this? Jack? It's another thing that will help propel your success, guys. If you read the material beforehand, easier to absorb. Chance? You guys have exams this week, or is it just?
Yeah, we have an exam tomorrow.
Yeah.
Class is that?
Audit.
Audit.
Who's teaching it?
Professor Brown. Ellen Brown.
Ellen Brown.
All right.
Yeah.
Willard Brown.
It's her first name.
What was that, James?
Professor Willard Brown.
Well, appreciate you guys being here, even though you have the exam tomorrow, so I'll chime in there. So better to be here unprepared than not to be here at all. So I'll leave it at that. You guys get to hear more of me now talk about this case. Here, someone bought famous bows for a violin. You know, I assume you don't play the violin. Right? And cost big money. And the interesting thing about them is you could play them, and they would generally be subject to wear and tear, but their value would not decrease. All right? So picture, if you will, that these musicians were using these bows. They wanted to take depreciation deductions. The fair market value of these bows remained constant. The question before the court was, should they be subject to depreciation deductions? Because normally, it's on having a useful life, right? Isn't that a predicate to getting depreciation deductions? Having a useful life. Seem to be, for lack of a better word, somewhat immortal, right? Because even after they were used, they maintained their value. IRS said no depreciation deductions. Taxpayer says there should be a depreciation deduction. Who wins and why? Case. Allowed the taxpayer to win. The taxpayer prevailed. Why did the taxpayer prevail? The taxpayer prevailed because these bows were subject to wear and tear. They were subject to wear and tear. Even though they didn't have a useful life, gee, the congressional policy was, after 1981, was to, when in doubt, permit taxpayers to take depreciation deductions. So there's a real policy emphasis on permitting depreciation deductions. So the court here said that this is a tough issue. On one hand, it was subject to wear and tear, suggesting depreciation. On the other hand, there was no useful life. So it was a very close question, but based on the legislative history of depreciation deductions and how the statute was formulated, the court decided to permit the depreciation deductions. So, at the end of the day, the taxpayer here prevailed. Look on page 417. Page 417, there's quick questions. 263 provides no deduction shall be allowed for any amount paid out for new buildings, right? That's our capitalization rule. Thus, if one pays for salaries or painting, etc., in construction of a building, expenses are capitalized and the total cost of the building is then depreciated, assuming 167 or 168 requirements are met. The company owns trucks that are used during the year exclusively in constructing a new storage plant for the company. The company allowed a depreciation deduction for the trucks during the year. Appreciate the value of the trucks. Well, they're using the trucks, but so you're saying they can't take the depreciation deduction? Why not?
Using the trucks in the business.
Isn't that true of any company? Like you have a landscaper who's using the truck to take the lawnmowers. Can't the landscaper deduct the cost of the truck? They're using, and here's, you remember I talked about Idaho Power, U.S. Supreme Court case, where if you use the trucks, build something of your own that you're going to use, right? This is, you're creating a plan for yourself, right? Here, the Supreme Court said when you self-construct, take a deduction. When you self-construct, you cannot take a deduction. You had to give me the right rationale. Not because you're using it in a trade or business, because by definition, every 1231 asset you're using in a trade or business. But here you're using it to construct your own building. In this case, then you have to capitalize the cost, because had you used a third party to construct the building, the purchase price would have included depreciation of the trucks, and therefore it would have had to be capitalized. Interest on the loans connected with the property and taxes on the property which are paid during the construction period currently deductible, because normally taxes, for example, property taxes, if you were to look at Code Section 164, would be deductible. Okay? Code Section 164 would permit deductions normally for property tax, but similarly, construction phase, if you bought a building once it was complete, who was selling you that property would, in the purchase price, capitalize the cost of interest and the property taxes and whatever the ancillary expenses are. So once again, Code Section 263, in this case, capital letter A, requires capitalization. That for all these ancillary expenses, if you're self-constructing, they all have to be capitalized as part of your cost of building. And if it's a commercial building, depreciated over 39 years. Now, beginning on page 418, let's go into more depth about depreciation, right? And tangible personal property, which I said, we looked at Code Section 168, and you need those three items, right? You need the recovery method, and you need to know the applicable convention, right? Those three things you need to know. Then if you look on page 420, just keep in mind that when it comes to depreciation, at the purchase price, initial cost basis is $80,000. In each instant, the taxpayer is going to be able to deduct $80,000, right? Everyone agree that when you acquire an asset for $80,000, declining 150% or straight line, in every case you're going to be ultimately able to deduct $80,000. And this table reflects that. But what this table also reflects is the fact that taxpayers would prefer double declining compared to straight line, compared to the alternative depreciation method, is even a slower method. And why does the taxpayer prefer the first compared to the second or third? Because of why, you guys know, time value of money principles, right? Deductions are worth more sooner rather than later. More sooner rather than later. Now, Congress can be generous, quote, and I'll call it stingy, all right? So let's talk about Congress's generosity and then its stinginess. At least for the time being, as I pointed out, to permit accelerated depreciation. Where is this memorialized? Code Section 168K. You see where it says additional depreciation on page 421? If you look 3 or 4 lines down from the italicized language on page 421, it says in the case of depreciable property, case of depreciable personal property acquired and placed in service after 2017 and before 2023, Section 168K, additional allowance for depreciation is 100%. Generally, all property except for real estate, and the authors say, you read that right with an exclamation point. You can depreciate or just deduct the entirety of your acquisition through the year 2022. What we're talking about in many instances, you might say, do I really need to know this because we could just deduct the entire purchase price? But my sense of the world, maybe yours too, when the country's running trillion-dollar deficits annually, this may not be sustainable, right? And my guess is that it won't be. 21 also talks about Code Section 179 bonus depreciation for small taxpayers. Small taxpayers, yesteryear when there was no Code Section 168K, Code Section 179 would allow, in this case, again, very generous, up to $1 million a year of bonus depreciation. What I mean by that is, this number used to be $25,000, just to show you that Code Section 179 was nowhere as generous, but Congress likes saying it's helping small business. So for decades, this number was 25,000. Then Congress says, we really have to help small business, and it defines small business as those businesses that put $1 million or less of property in service can immediately expense it. Is it sustainable or not? And by the way, when we start class on Monday, I'm going to go through this again. James?
How does Congress define property in service?
That you use as a 1231 asset when you and start using it to make money is property placed in service.
Does that include like sales companies?
I don't know what you mean by sales company.
Those companies might not have any assets.
Sales company. I don't know what you mean.
Sell a service to a pharmaceutical company.
A service business?
Yeah.
What are you putting in service? Are you buying cars for your employees so they can drive to sell their drugs?
You're teaching doctors.
Right.
A service asset that's not asset
I
intensive.
don't know what you mean. I'm thinking, is it tangible or intangible?
I'm just referring to companies with low assets but high revenue, over $1 million.
Don't have assets to expense, what you're saying. A trained labor force that goes out and does training sessions, right? The assets they can expense because they just.
Right, it's up to $1 million.
But keep in mind, in a world where right now Code Section 168K is you can expense anything, and you could be Google or Amazon, major companies, Apple. You make acquisitions that are not real estate, you can just take the whole thing off as an expense, right? If you read the piece I wrote about corporations not paying any tax, it's not a surprise, at least for the 2018, 2019, 2020, because anything they acquire, even though it may produce income for many years, they're 1231 assets, they're able to do an expense immediately. 179 is, but again, taxpayers don't need Code Section 179, at least for now, because right now they can rely on Code Section 168K. It does put the brakes, no pun intended, on page 423 on so-called listed property. Listed property for our purposes is primarily cars, where they limit what you can deduct with respect to so-called luxury cars, which we'll look at next class, and some other kinds of properties. Now, page 425, put your attention, amortization of intangible personal property. Last full paragraph starts with under the provision. It talks about 3 or 4 lines down being a 15-year amortization period. It says beginning with the month. I have the word month in which the asset is acquired. We're going to see the word month. I'm just calling to your attention from that. Practitioners extrapolate and say you get the full month convention. That's where it derives the full month convention. Let me give you some foreshadowing about our next class, guys. I'm going to go through depreciation. We're going to spend a fair amount of next class on depreciation because, again, you're going to see this on the final exam. I want to make sure you're going to see this in practice. You got to know depreciation rules, all right? So we're going to review everything we just spoke about, just the general precepts. And then on page 428, we're going to talk about the depreciation rules as they pertain to real estate. Because, once again, those rules are going to be important in terms of your abilities. For your world, you got to know the rules as they apply to tangible personal property, and then there's very different rules as they apply to real estate. What we're going to do towards the end of next class on Monday, look at page 433. It talks about deductions for profit-making non-business activities. Do you guys have a different word for that you might refer to? A word that comes to mind? Oh? Code section 183 is hobby. Investment. Investment expenses. And with respect to investment expenses, you guys are going to add a new code section. It's a very exciting moment. Your ever-growing repertoire of code sections. What code section comes to mind, or you can look for yourself? 12, right? It's going to become a new code section because let's face it, guys. It costs money. It takes money to make money in a trader business. Agreed? Everyone agree? But when you make investments, right? Often when you make investments, it takes money to make money when you make investments, right? So if you go out and buy real estate as an investment, not as a trader business, you're going to just invest. Hope the real estate appreciates. You're going to see those expenses may be deductible, but guess what's the peanut butter and jelly section to 212? Final word?
274.
270. Well, 274 will periodically apply to 212 expenses, so I like the way you think, Kyle. But 263. So just like 162, sometimes you have to capitalize the expense. Similarly, with respect to your 212 expenses, guess what? Sometimes you have to capitalize those expenses, right? Why do we do this, guys? Good luck on your exam tomorrow. And I will hopefully see everyone on Monday. All right?
Yes.